Markets initially reacting positively to the beat on that factory output, retail sales, fixed asset investment. How optimistic should we be feeling about that data at the moment?
Right. I think the focus is clearly on the sequential improvement in the data, which is signaling stabilization. It's not great, but it's certainly a lot better than I think it was in Q1. I think one of the most encouraging aspects of what you just posted on the screen is I think what's happening in retail sales, and particularly car sales beneath the surface. So that was well over half of the consumption weakness last year. That seems to be clearly bottoming out now. There was some sales promotions related to cars being phased out for emissions, and so that's starting to lift some of the IP in the retail sales data.
Aaron, good morning to you. Many are going to speculate that this is perhaps the consequence of re-leveraging by the PBOC coming to bear. Have a look at this chart, because this is the global repercussions about where we are. This is China's trading partners, flash PMI, sub 50. So the world is still in a very uneasy state. Do you think it's going to take more stimulus from the PBOC to get us back above this 50 plimsoll line globally?
Yeah, I think China's doing just about enough to stabilize its own economy. It doesn't look like they're doing enough to really have positive spillover on anybody else. So, and you see that, I think, in a little bit in the detail of their own data. So the primary sector is a bit better, which is mining, agriculture. Services stable. Manufacturing still weak. So you're not getting a lot, even from their own stimulus, not getting a lot of sort of spillover into manufacturing. And so, it's a bit mixed. So I think a lot of the improvement you're seeing in the Chinese data is sort of a natural bottoming out process of the property sector, of car sales, things that have nothing to do really with the stimulus. The stimulus has been quite choppy. So where you would expect to see that is in things like infrastructure, which has been sort of up, down, up, down. There's not really a clear trend yet showing you that credit impulse is improving, even though on the numbers it is improving.
Yeah, it's really interesting that you bring up the infrastructure, because a lot of people say to me, look, it's the fixed asset investment you need to focus on. Of course, right now, a lot of that coming down to the infrastructure. One leading indicator I was reading this morning for infrastructure investment is excavator sales. So you say that's been kind of up and down. Is that an area to maybe still be a little bit more concerned about while we're seeing the retail sales and other parts of the domestic economy improving? Well,
it was supposed to be the workhorse that sort of got out of this, right? So the one lever they really control is infrastructure, particularly public infrastructure. You've seen an injection of liquidity into that space. It's been a bit surprising that it's not generated a more sustained trend in activity. But as I said, I think because all the other parts of the economy are actually getting better at the margin, it's sort of enough to keep you around 6% growth.